Nothing looks wrong right now. And that's exactly why you should be paying attention. Silver is calm. The charts look orderly. The headlines are quiet. No panic, no frenzy, no screaming volatility. But this is the most dangerous moment in the entire cycle, because we are entering settlement week. And settlement week is not when chaos begins. It's when the mechanism clicks into place. This is the window where paper promises are forced to confront physical reality, where contracts can no longer hide behind rollover excuses, and where decisions that have been delayed for months suddenly become mandatory. Every major spike, every violent smash, every this shouldn't be happening move in silver history has one thing in common. It didn't start with breaking news. It started with silence. While most traders are distracted by short-term price candles, the real pressure is building underneath the surface. In open interest, in margin requirements, in delivery expectations. Settlement week is a trap because it looks boring right up until the moment it isn't. Liquidity thins, urgency rises, and the market loses its ability to absorb stress. When that happens, silver doesn't move smoothly. It gaps, it snaps, it shocks. And by the time most people realize what's happening, the move is already over. What we're about to discuss isn't speculation or hype, it's structure. And once you understand how settlement week actually works, you'll understand why volatility isn't coming randomly. It's scheduled. To understand why settlement week is so dangerous, you first have to strip away the comforting illusion that the silver market is driven primarily by sentiment, headlines, or technical patterns. It isn't. Those are surface-level reflections. Underneath, silver is governed by a rigid contractual machine, and settlement week is the moment when that machine demands answers. Every futures contract represents a promise, not an opinion, not a bet, but a legally binding obligation. As settlement approaches, every holder of those contracts is forced into one of three choices: close the position, roll it forward, or stand for settlement. There is no fourth option. You can't delay. You can't wait and see. The calendar removes ambiguity, and that's where stress begins. In normal weeks, the system runs quietly in the background. Liquidity is abundant. Positions can be rolled effortlessly. Weak hands are absorbed without drama. But settlement week is different because the volume of decisions compresses into a very short window. Large players who have been sitting comfortably on paper exposure suddenly have to act all at once. Rolling contracts requires liquidity. Closing contracts requires counterparties. Standing for settlement requires confidence that delivery can actually occur. When many participants attempt to resolve these obligations simultaneously, the system tightens, spreads widen, depth disappears. What looks like a deep liquid market on your screen starts behaving like a narrow hallway with too many people trying to exit at the same time. This is where the trap forms. Settlement week doesn't announce itself with volatility, it announces itself with stillness. Price often goes flat or trades in an unusually narrow range just before pressure releases. This lulls participants into believing risk has diminished. In reality, risk has merely become latent. Open interest may still be high, but liquidity is quietly evaporating as dealers reduce exposure ahead of forced decisions. Market makers widen quotes. Algorithms become less willing to absorb size. Every action is defensive, not expressive. The system is bracing itself. What makes settlement week especially dangerous for silver is the unique imbalance between paper volume and physical availability. Silver futures trade at multiples of annual mine supply. This is tolerated because most contracts never result in delivery. The system functions on the assumption that most participants will roll or cash settle. But settlement week challenges that assumption. It's the one period when delivery intent matters most, when even a small shift in behavior can overwhelm the mechanism. If a higher than expected percentage of longs choose not to roll, if they choose to stand, the pressure doesn't increase linearly. It explodes. At the same time, shorts face their own constraints. A short position is not simply a price bet. It is a promise to deliver or financially cover delivery risk. As settlement approaches, margin requirements tighten. Risk models become less forgiving. A move that would have been manageable 2 weeks earlier suddenly becomes intolerable. Shorts are forced to reduce exposure, not because they want to, but because the system demands it. And when multiple shorts attempt to exit or roll at the same time, they compete for liquidity that may no longer exist. This is why settlement week often produces moves that seem irrational. It's not about news. It's not about narratives. It's about timing mismatches. Liquidity is lowest precisely when urgency is highest. That is the core structural flaw. Futures markets are designed to distribute risk smoothly over time, but settlement week collapses that time dimension. It forces risk to be resolved immediately. When too much unresolved exposure exists, price becomes the release valve. Another critical element is how settlement week alters incentives. During normal trading, participants can afford to be patient. During settlement, patience becomes expensive. Holding risk into expiration carries escalating costs, both financial and psychological. This causes behavior to change abruptly. Traders who appeared confident days earlier suddenly rush to neutralize positions. Hedgers adjust aggressively. Algorithms flip from passive to reactive. The market's personality shifts, often within hours. Importantly, this volatility is not evenly distributed. It clusters. One sudden move triggers margin calls, which trigger forced adjustments, which trigger more moves. The feedback loop is fast and unforgiving. This is why settlement week volatility often appears as sharp spikes or sudden drops rather than gradual trends. The system doesn't unwind gracefully, it snaps. And this is where most observers get it wrong. They look for external catalysts, economic data, central bank comments, geopolitical headlines. But settlement week doesn't need a trigger. The trigger is the calendar itself. The pressure exists regardless of headlines. News may align with the move, but it doesn't cause it. The cause is structural compression. Silver, in particular, magnifies this effect because it sits at the intersection of industrial demand, monetary hedging, and speculative leverage. It is small enough to be overwhelmed, yet critical enough to matter. When settlement week forces adjustments, silver doesn't absorb them quietly. It reacts violently because the buffer between paper claims and physical reality is thin. So when you hear that nothing is happening heading into settlement week, understand what that really means. It means positions are unresolved. It means obligations are approaching maturity. It means liquidity is retreating. And it means the system is becoming fragile. Settlement week is not a neutral event. It is a stress test. And when stress tests are failed, the result is never subtle. What turns settlement week from a technical process into a volatility engine is not fear or speculation. It S-forced behavior. This is where the trap closes. By the time settlement arrives, the market is no longer operating on preference. It is operating on obligation. Every large participant knows the clock is running, and when time pressure meets leverage, volatility becomes inevitable. This is the moment when silver stops behaving like a chart and starts behaving like a system under strain. The first accelerant is margin. As settlement approaches, clearinghouses do not relax. They tighten. Risk parameters adjust to reflect the reality that positions are about to mature. That means margin requirements increase, sometimes quietly, sometimes abruptly. A position that was comfortably funded days earlier suddenly becomes expensive to hold. This is not theoretical risk. It is immediate cash demand. Participants who cannot or will not post additional margin are forced to act. They don't wait for confirmation. They don't wait for a better price. They exit, roll, or reduce exposure immediately. This creates one-sided urgency. At the same time, liquidity providers pull back. Market makers are not charities. When uncertainty rises and time compresses, they protect themselves by widening spreads and reducing size. This is invisible to most traders until it matters. The order book still looks populated, but it is thin beneath the surface. What used to absorb large orders with minimal impact now reacts sharply. A single forced order moves price more than expected. Then another follows. Then another. The market begins to slide or surge not because of emotion, but because there is nothing left to stop it. Algorithms make this worse, not better. Many trading systems are designed to detect volatility and respond to it. When settlement pressure creates the first abnormal move, these systems flip from passive to aggressive. Stops are triggered, momentum strategies activate, volatility targeting funds rebalance. What began as a structural adjustment cascades into a self-reinforcing move. This is why settlement week volatility often feels sudden and disproportionate. It is not one actor acting irrationally. It is many actors responding rationally to the same constraint at the same time. Another critical factor is position asymmetry. Not everyone enters settlement week equally prepared. Some participants are hedged, funded, and flexible. Others are overleveraged and dependent on smooth conditions. Settlement week exposes this difference brutally. The strong do nothing. The weak are forced to move, and when the weak are forced to move, they move fast. This is why price action during settlement often looks violent but brief. The market is flushing vulnerability, not expressing consensus. Silver's volatility during this period is further amplified by its dual identity. It is both a financial instrument and a physical commodity. During settlement week, these two identities collide. Financial players are trying to manage exposure, while physical considerations quietly loom in the background. Even the possibility of delivery stress changes behavior. Participants begin to price not just what silver is worth, but what it might cost to avoid obligation. That risk premium appears suddenly and disappears just as fast, but while it exists, it moves markets. Importantly, volatility during settlement week does not require imbalance to be extreme. It only requires imbalance to exist at the wrong time. A market can tolerate massive leverage when time is abundant. It cannot tolerate moderate leverage when time runs out. Settlement week removes the safety valve of delay. Everyone must resolve risk now. That is the true catalyst. This is also why the direction of the move often confuses observers. Settlement volatility is not directional by nature. It can produce sharp rallies or brutal drops depending on where pressure is concentrated. If shorts are more constrained, price spikes. If longs are more leveraged, price collapses. The key point is that the move reflects stress resolution, not value discovery. Price overshoots because the goal is not efficiency, it is survival. And once the move starts, it feeds on itself. A sudden drop forces additional margin calls on longs. A sudden spike forces shorts to cover. Each response adds fuel. The market becomes reflexive. Participants are no longer making choices. They are reacting to consequences. This is when silver shouldn't move the way it does. And yet it does, because the model assumes time that no longer exists. By the end of settlement week, the volatility often subsides as quickly as it appeared. Positions have been cleared. Exposure has been reduced. The system breathes again, but the damage, or the repricing, is already done. Those who were prepared remain. Those who weren't are gone. And the chart records the event as a mystery move that analysts will later attempt to explain with headlines that had nothing to do with it. This is the settlement week trap. Volatility doesn't explode because something unexpected happens. It explodes because something unavoidable happens. The calendar turns, obligations mature, liquidity retreats, and silver sitting at the fault line between paper and physical absorbs the shock. If you understand that, then the violence of settlement week isn't surprising at all. It's mechanical, and it's coming whether the market feels ready or not. Settlement week doesn't punish everyone equally. In fact, it is designed, unintentionally but reliably, to transfer stress from those who are prepared to those who are not. This is where the asymmetry of the silver market becomes impossible to ignore. While most participants experience settlement volatility as chaos, a smaller group experiences it as opportunity. The difference isn't intelligence or prediction, it's positioning. Retail traders, short-term speculators, and highly leveraged funds are structurally disadvantaged during settlement week. Their strategies depend on liquidity, smooth execution, and the ability to adjust positions gradually. Settlement removes those comforts. When spreads widen and order books thin, stops don't behave the way they're supposed to. Exits slip. Risk models fail in real time. What looks like a manageable position on a normal Tuesday becomes an existential threat on a settlement Thursday. This is why so many participants feel blindsided every time it happens. Not because the move was unpredictable, but because their structure was fragile. On the other side are institutions that understand settlement week as a recurring event, not a surprise. They reduce exposure early. They avoid being forced to act. They keep excess margin. Most importantly, they do not chase price during the week itself. They let volatility come to them. When weaker participants are forced to liquidate into thin markets, stronger hands absorb that flow at favorable prices. This is not predatory in the emotional sense. It is mechanical. Markets reward those who can wait while others cannot. Banks and large dealers occupy an even more insulated position. Their goal during settlement week is not profit maximization, it is risk minimization. They care less about direction and more about surviving the process without being forced into disadvantageous delivery or margin scenarios. This is why price behavior during settlement can feel deliberately hostile. Moves often occur at times of low participation. Liquidity vanishes suddenly. Volatility appears without warning. These are features of a system trying to shed risk, not bugs in the system. Physical holders, by contrast, are largely unaffected by settlement week noise. They are not subject to margin calls. They are not forced to roll or close positions. The price can move violently against them on paper without changing their underlying position. This creates a profound divergence in experience. While leveraged players experience settlement as danger, physical holders experience it as confirmation. Every spike or smash reinforces the reality that price is being driven by financial stress, not changes in physical supply or demand. This divergence is crucial because it explains why settlement week often shakes out confidence rather than fundamentals. Those who need price stability to function lose conviction. Those who do not need immediate liquidity gain it. Over time, this dynamic concentrates ownership in fewer, stronger hands. Settlement week accelerates that process. It is a filter. There is also a psychological element at work. Volatility during settlement week feels unfair because it is impersonal. There is no villain, no headline to blame, no clear narrative. The market moves because it must. Humans are wired to look for intent, but settlement volatility is indifferent. It doesn't care about your thesis. It doesn't care about your timing. It only cares about whether your position can survive resolution. This is why so many participants vow never to trade silver again after experiencing a settlement week move. They weren't wrong about direction. They were wrong about structure. Another group that benefits quietly during this period is patient capital. Long-term allocators who understand that settlement volatility is temporary use these events to build positions, not exit them. They don't try to catch the exact bottom or top. They wait for forced selling or forced buying to distort price away from equilibrium, then step in when others are forced out. Settlement week provides these distortions regularly. It is one of the few times when price moves are driven by necessity rather than opinion. Importantly, none of this requires coordination or conspiracy. The system produces these outcomes naturally. When time pressure meets leverage, weak structures fail first. Settlement week simply concentrates that process into a narrow window where it becomes visible. This is why experienced participants respect settlement. They don't dismiss it as a technicality, they plan around it. By the time settlement week ends, the market often looks calmer, but it is not the same. Positions have been transferred. Risk has changed hands. Confidence has been tested. Those who survived feel emboldened. Those who didn't are gone. And the price, wherever it lands, reflects not just supply and demand, but endurance. Understanding who gets caught and who doesn't tee is essential if you want to stop being surprised by silver and its behavior. Settlement week is not random violence. It is selective pressure. And like all selective pressure, it reshapes the landscape quietly, one forced decision at a time. What makes the coming settlement week different and more dangerous is not the mechanics themselves, but the environment in which those mechanics are now operating. Settlement has always been a stress point, but stress only becomes destructive when buffers are thin. Today, nearly every buffer that once absorbed volatility in silver has been weakened or removed. This is why the next explosion in volatility won't look like the past. It will be faster, sharper, and harder to contain. The first broken stabilizer is inventory. In previous cycles, settlement pressure could be relieved by the quiet availability of metal. Even if delivery demand spiked, the system had enough slack to accommodate it without panic. That slack is gone. Inventories are tighter, more encumbered, and less willing to move. This doesn't mean delivery will fail. It means the cost of certainty has risen dramatically. During settlement week, even the perception of scarcity alters behavior. Participants act defensively, not because metal is unavailable, but because they can no longer assume it will be available on favorable terms. The second stabilizer that no longer functions reliably is arbitrage. For decades, price dislocations between futures, spot, and international markets were quickly corrected by capital flows. That mechanism is now impaired. Regulatory friction, higher financing costs, and geopolitical fragmentation have slowed the movement of metal and capital. When settlement week creates stress, it can no longer be smoothed out instantly. Dislocations persist longer, and while they persist, volatility compounds. Third, leverage has become more fragile. The post-2008 world trained institutions to manage risk through complexity, not simplicity. Hedging chains are longer. Dependencies are tighter. This works in calm conditions, but settlement week is not calm. When one link tightens, pressure propagates rapidly. A margin call in silver doesn't stay in silver. It forces adjustments elsewhere, pulling liquidity from unrelated markets. This cross-market sensitivity amplifies every move. Another critical change is behavioral. Market participants are more reactive than they used to be. Algorithms dominate volume. Volatility targeting is widespread. Risk parity and systematic strategies rebalance mechanically. During settlement week, when volatility rises for structural reasons, these strategies reduce exposure automatically, regardless of fundamentals. This creates selling or buying pressure that is blind to value. The market becomes reflexive, not rational. Perhaps most importantly, trust has eroded. In earlier periods, participants trusted the system to function smoothly through settlement. Today, that trust is conditional. Every participant knows that stress events now escalate faster than responses. This changes how people behave before settlement even begins. Defensive positioning starts earlier. Liquidity retreats sooner. The market enters settlement week already tense. That tension doesn't need a spark. It only needs time to run out. This is why volatility now clusters around settlement rather than dispersing across the month. The system is front-loading stress. When settlement arrives, there is no excess capacity left to absorb it. The result is not a slow adjustment, but a release. Price moves not because new information arrives, but because old risk can no longer be hidden. Looking ahead, this means silver will increasingly behave in a way that confounds traditional analysis. Technical levels will break without warning. Correlations will fail. Moves will appear exaggerated relative to volume. Analysts will search for explanations after the fact, but the cause will remain structural. Settlement week has become the moment when the paper model is forced to reconcile with physical constraints and financial reality. For investors and observers, the implication is clear. The most dangerous time to assume stability is when the calendar says otherwise. Settlement week is no longer just a date. It is an event. And in a system with fewer buffers, events carry consequences. Volatility is not a sign of malfunction. It is a sign of truth. It reveals where pressure exists and where it can no longer be contained. As silver continues to operate at the edge of paper capacity and physical constraint, settlement week will remain the point where that tension becomes visible. This is why the next move will feel sudden, why it will feel unjustified, and why it will feel impossible to trade in real time. It is not designed to be traded, it is designed to be survived. Those who understand the structure will not be shocked. They will be ready. And when the volatility passes, the market will look calm again as if nothing happened. But something will have changed. It always does.